And now we want to get back to our guest for a little bit more on the markets. Let's bring in Phil Toews, the CEO and co-portfolio manager for Toews Asset Management. Phil, great to have you on. There is continuing unrest in cities across the country. We're in the middle of a global pandemic. Markets, though, yesterday closed higher, inching back to their records. Futures pointing higher today. So what is it that actually matters to investors here?
Well, so our assessment is the level of analysis that we're seeing is something akin to water good, fire bad. All that investors are looking at are some qualitative information. In this case, it's vaccines good, reopening economies good. But what's not happening, and this is what investors have a really hard time doing, is they're not taking this qualitative information that we're getting and able to make it quantitative. And ultimately, the quantitative is going to be asking, do the prices that we're paying for stocks, are they justified by the earnings companies are producing? And you can talk about high valuations, but I think the thing that we would look at is potentially negative multiples, because what happens is if you have losses at companies and you divide that by a price, you have a negative price earnings ratio. So I think that uh, ultimately, regardless of how much buying the Fed does or anything else that is spurring stocks higher over the short term, we think stocks are going to be challenged. Even reopening economies aren't going to deliver a robust GDP growth for the country.
Investors are hoping for near-term economic recovery. They're focusing on the country's reopening. Any concern that these protests, though, could derail that and prevent that from happening?
Yeah, there are always concerns. I mean, if you're an investor, it's all about fear and greed. And right now, there could be fear associated with protests. But if you look at the history of protests, at least in the last couple of decades, uh, these things crescendo and ultimately subside. And so I think what you're seeing by the investor marketplace is that there's not a lot of fear for these having an impact on the economy or on the growth of stocks over the short term. Really, actually, since protests have begun, we've seen stocks do nothing but move higher. So uh, it's grievous to see this happening. You never want this to be playing out in cities, but I think the effect on stocks at the moment is going to be diminished.
How far ahead are the markets compared to the economy right now? We know that markets do tend to lead it, but what is the timeline that the markets are thinking for the economic revival?
Well, we think the stock market's way ahead of itself, and the time that we would point back to is, if you recall, back in late January, early February, and this is after the coronavirus already began to take off in China, and there was a fear that it could become a global pandemic. After the stocks made a short downturn, they set new highs in early February. And of course, that was an ill-fated move, because after that we saw stocks move down rapidly. And when you look back at that moment, you say, well, there was really no justification, no rational reason for stocks to increase as they did, and we think that's where we are right now. There's just, when you think about future earnings of companies and the fact that there's no visibility for what to expect from stocks, we don't have a medical solution. We have things that might be medical solutions, uh, but this could play out to the end of the year. But people haven't even begun to consider that this could play out into 2021 before we have a real medical solution that's going to get things really spurred again. So we think stocks are ahead of themselves.
I want to turn now to what's happening between the U.S. and China. China is now asking state firms to halt purchases of soybeans and pork. That would potentially be a violation of phase one of the trade deal. How concerning is this for investors? And does it feel like we're just back at the point where there's going to be some type of trade war between the U.S. and China?
Well, so when you juxtapose the China situation against the global pandemic, it actually seems like small change. Um, yeah, that was the concern for over a year, as markets tried to muddle through and anticipate what the impact of trade negotiations was going to be. It can't help. So if you've already got a challenged economy, and now you have additional issues coming along with trade, it only potentially further depresses economic activity, which helps make our case that stocks at the moment are overstretched. And so I think that investors need to find a path right now that's going to work whether we see stocks continue to move higher or also if they move lower.
Several big tech companies, including Apple, manufacture products out of China, of course. So, how
Right.
significant do you think that these tensions will be for the tech sector?
Well, companies like Apple seem to have done fairly well despite all of the even much more intense trade issues that we saw over the prior 18 months. So yes, it could definitely have an impact if this becomes something more than just a discontinuation of purchasing some agricultural products. Apple hopefully will be immune. Let's just see how this plays out. Um, could it take on a life of its own? Definitely. And I think that's what you need to watch for if you're an investor is that if you see this becoming something akin to the big sanctions that we saw during prior trade frictions, then that could be a big concern for the markets.
Okay, Phil Tays, CEO and co portfolio manager of Tays Asset Management. Great to have you on.